All right, let's get right into it. We've worked your whole life, you've saved, you've done all the right things to build that nest egg, but how do you actually defend it when things get volatile? Today, we're talking about how to build a real financial fortress around your retirement savings. This is the question that probably keeps a lot of us up at night. You can do everything right, save millions even, and still be totally vulnerable. How is that possible? Well, it turns out one of the biggest risks to your retirement has less to do with how much you saved and everything to do with when you start spending it. So here's our game plan. We're going to start by pulling back the curtain on this hidden risk. Then we'll look at a wild case study that shows it in action. After that, we'll get practical with a 3-part strategy to build your fortress, covering the foundation, the special defenses, and most importantly, how to be a calm, cool commander of it all. Okay, first up, let's talk about this invisible threat. We're all taught to focus on one big number, the average annual return. But, and this is a huge but, the moment you start taking money out of your portfolio, the order of those returns, the sequence, completely changes the game. This is called sequence of returns risk. So what does that actually mean? Well, to put it bluntly, it's the nightmare scenario of retiring just as the market tanks. When you're pulling money out to live on while your portfolio's value is also shrinking, it's a double whammy. It creates this downward spiral that is incredibly hard to pull out of. To really get a gut feeling for how serious this is, let's look at a story, a tale of 2 retirees. And trust me, this simple example shows you everything you need to know about why this matters so much. So, meet investor A and investor B. On paper, they look like financial twins. Both start with a cool $3 million. Both plan to withdraw the exact same amount. And get this, over the next 25 years, they both get the exact same 7% average return. The only thing that's different is a little thing called timing. Investor A, poor soul, has the worst luck imaginable. They hang up their work boots and bam, the market just falls off a cliff. So now they're forced to sell their investments when prices are in the gutter, just to pay the bills. Every withdrawal digs a deeper hole, eating into the very capital that's supposed to support them for decades. And the result? It's brutal. After all that work, after just 19 years, that $3 million portfolio is completely empty. Zero. Gone. Just let that sink in. It's a shocking reminder of how vulnerable a great plan can be to bad timing. Okay, now let's flip the coin and look at investor B. They retire into a booming market. Their money grows and compounds for over 2 decades, building this huge financial cushion before they ever hit that same rough patch that destroyed investor A right at the start. And the difference is just mind-blowing. After 25 years, investor B has funded their entire retirement, and they still have over $6.4 million left over. I have to say it again, they had the same average return. The only thing that changed was the sequence. So the real question is, how do we make sure we're not investor A? Okay, we've seen the problem. It's scary, right? So now let's talk about the solution. This is where we stop worrying and start building. We're going to construct a portfolio that is designed from the ground up for resilience, a true financial fortress. And every good fortress starts with a rock-solid foundation. So this foundation has 3 key parts. You've got your basic asset allocation, just getting the right mix of stuff. Then there's a really smart strategy called the bucket approach. And finally, a way to fight off that silent killer, inflation, by owning real assets. The bucket approach is awesome because it's so easy to picture. Imagine 3 buckets. Bucket number 1 is your now money. It's got 1 or 2 years of living expenses and super safe stuff like cash. The whole point is, if the market crashes, you don't even flinch because you're not selling stocks to pay for groceries. Your other buckets are for later, giving them plenty of time to ride out the storms. But, it's not just the big, loud market crashes we have to worry about. There's another enemy, a silent attacker, always trying to sneak through the walls. And that's inflation. It's exactly what this quote says. It's that slow, creeping feeling that your money just doesn't go as far as it did before. And that is why owning real assets is so critical. We're talking about stuff like real estate, infrastructure, commodities, things you can actually touch. They act as an inflation shield for your fortress. Their value tends to go up when everything else costs more, and they add another solid layer of stone to your foundation. All right, so the foundation is strong. That's great. But what if you look out from the castle walls and see some really dark clouds on the horizon? Well, sometimes a fortress needs to raise the shields. This is where we can get a little more tactical with our defense. One tool for this is called a protective put. And I know the word options can make people's eyes glaze over, but just hang with me. The concept is actually pretty simple. You're basically buying the right to sell your investment at a locked-in price. It's like putting a safety net under your portfolio. You're saying, I will not lose more than this much. It's definitely not an everyday tool, but it's a powerful shield in those really uncertain times.
Honestly, this is the perfect way to think about it. It's portfolio insurance. You pay a little bit of money up front, that's called the premium, for a whole lot of peace of mind. If the storm passes and nothing happens, okay, you spend a little for security. But if that hurricane hits and the market plummets, your insurance policy kicks in and saves you from a total disaster.
And you can see the trade-off right here in the numbers. Look, if the market goes up, yeah, you make a little less with the hedge because you paid for that insurance. But check out the downside. If the market drops 20%, the unhedged portfolio loses a massive 200 grand. The hedged one? It loses only 38,000. You're trading a little bit of potential upside to avoid a catastrophic loss. Okay, so we've built the foundation, we've added a tactical shield, but here's the thing. A fortress is only as strong as its commander, and in this case, the commander is you. The final and arguably most important part of your defense is managing your own psychology. So let's do a quick self-check. Be honest, are you that person who's checking their account balance 10 times a day? Do you read a scary headline and immediately feel that pit in your stomach, that urge to just sell everything and run? If that sounds familiar, you might be your own worst enemy. One of the biggest traps is something called action bias. It's that panicked voice in your head screaming, do something when things get scary. But that's usually the worst thing to do. The countermove? Schedule your decision-making. Don't react to the daily news. Commit to reviewing your plan on specific dates, like once a quarter. This builds a deliberate pause between emotion and action, and it keeps the disciplined commander in charge. And I love this metaphor because it just nails it. You don't need to be a fortune teller. You don't need to know what's going to cause the next crisis. You just need a well-built ship. That's your resilient portfolio, and the discipline of a skilled sailor to navigate the storms that you know are going to come eventually. And that leaves us with this one last crucial question. For most of your life, the focus is all about growth. But as you get close to retirement, resilience becomes just as important, if not more so. So ask yourself, is your portfolio just built to grow, or is it truly built to last? Because getting to your destination is only half the battle. Making sure you can stay there securely is the whole point.